Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com. And I'm so excited you have joined me today. We do the show live every Tuesday to help you learn the ins and outs of passive investing, no matter whether it is you going in your first investment or if you're a seasoned investor. We help you demystify all the skills, mindsets, and even, networks that you might need to have in order to be a confident investor and take your active income or maybe your business ownership income and turn it into passive long-term wealth. Now, before we get started, don't forget to check out passiveinvestingwithwhitney.com. If you go there, you can get access to my calendar and we can talk all things passive real estate and help you understand how this amazing investment vehicle can really help you match or scale your portfolio to your goals. All right, let's dive into today's content. Today, we are going to talk about demystifying capital calls, how to safeguard your investments and make confident decisions. Now, if we haven't met before, again, my name is Whitney Elkins-Hutten, and really you're in the right place if you want to turn your long-term or if you want to turn your active income into long-term wealth. All right, if that's what you want to do, you're in the right place. But maybe you've hit a few snags there. Maybe you've tried to actually invest passively and you just couldn't get comfortable making the investment. Maybe you actually invested in a deal before and realized, ooh, I maybe made a mistake or made a rushed decision. Or maybe you just simply want to sharpen your skills. If this is what you want to do, again, you're in the right place. Before we get started, a little bit about me, if we haven't met already. This is the whole reason why I invest in passive real estate. It's me and my crazy crew here. I love traveling, spending time with my family. Right now, we're in beautiful sunny Sedona, but it's really our passive investments, not our active ones. Our passive investments is what allows us to do this, allows us to step into having choice on how we spend our time. Now, I have scaled an $800 million real estate portfolio. That includes 6,500 more residential units, 15 express car washes, 2,200 self-storage units, and a myriad of other investments. I flipped over 5 million in real estate. And again, as you know me, I'm the Director of Investor Education here at PassiveInvesting.com. I also coach people one-on-one on how to dial in their investment plans and master the mindset on how to be a passive investor. I'm also the author of Money for Tomorrow, How to Build and Protect Generational Wealth. And then, of course, this YouTube show and podcast. All right, but all of this is in service of one result, and that is how can I get 100% control and choice on how I spend my time? And so for me, I started off real estate investing back in 2002, actively doing live-in flips and house hacks, and then scaled a 36 to almost 40 unit single family rental portfolio, transitioned into active multifamily holdings, both by myself and in joint venture and GP partnerships. And then eventually, started taking a lot of the income and the capital gains and moving that into passive real estate, and other passive investments. And that is what unlocked that freedom for me, which is how I get 100% control and choice on how I spend my time. And we can help you do that here at passiveinvesting.com and diversify across all parts of the capital stack, whether that is going into one of our equity placements. We have over 1.4 billion assets under management on the equity side of our portfolio, or going into one of our debt placements. And we have lent over 363 million through our PIC real estate debt fund, which is deployed by Rehab Wallet. Now, if you're looking on how can you learn more about passiveinvesting.com and what we do here, again, you can join our Passive Investing Club. Simply go to passiveinvestingwithwhitney.com and get all the benefits that you see here on the screen. Now, today, before we dive into our topic, I just need to let you know this is not financial advice, legal advice, or tax advice. As always, in any webinar on YouTube or on the interwebs that you see, make sure you take that advice and then take that advice back to your investment team before making any investment decision. All right, so capital calls, what are they? Why should we understand them or even care about them as a passive investor? And how can you actually make a decision and then moreover be prepared? Because it's not a matter of if you're going to have a capital call, it's when. If you passively invest, if you actually just invest long enough, it's a matter of when will there be a capital call. Now, let's first start off. What is a capital call? Well, a capital call occurs when an investment operator or sponsor requests additional funds from investors to address unexpected expenses or seize strategic opportunities. Now, capital calls can happen for a variety of reasons. Right now, in this market, we're seeing a lot of capital calls because of the debt profile that has been placed on some of these properties, especially ones that were purchased in 2021 and 2022. Okay, so capital calls can happen for a variety of reasons: market shifts, operational challenges, or maybe there's a value enhancing opportunity on the property. All right. Now, we did a webinar with one of our founding partners, Dan Hanford, back on the Passive Investing Masterclass last May. And Dan was very clear with us to let everybody know that capital calls aren't just for emergencies. They actually can be tools to help safeguard or enhance an investment. Now, I want to create an analogy here because I actually got it when I put out this webinar topic. We had somebody write in and said, capital calls are always 100% bad. They're always for mismanaged projects, okay? Which simply isn't true. And let me create an analogy that maybe you can relate with. If you own your primary house and then all of a sudden a wind event happens, okay? I just recently had a client that had a wind event in the Seattle area, in the Northwest Territory area. And anyways, and it rips off part of your roof. Okay, are you now going to call your house a complete wash? Okay, are you just going to walk away from it and say, hey, I'm not going to repair the roof. There's no value here. I'm not going to put any money in it. The deal is dead. Or are you not going to repair your roof just in case the next storm comes, right? Now you're leaving your house unprotected. Okay, so capital calls in your own personal situation, if you own any real estate, maybe for us personally, our heater just experienced issues and we had to do a big like furnace repair. That was a capital call, infusion of capital that we were not expecting. I've had boiler go out at a rental property. Okay, now all of those required an infusion in capital that was above and beyond my original business plan. Okay, and simply in this case, capital call, it can be for that reason. It can be due to market shifts. It can be due to, the other things that are outside the operator control. Now, I don't want to sugarcoat it. There are projects out there that are very bad and operators are doing capital calls. And that's why we're here today, is to suss out what are capital calls that are worth pursuing versus capital calls that are actually possibly the red flags that we shouldn't be pursuing at all. Okay. Now, again, let's just name right off the bat what an investor, should be avoiding, okay? Mistakes to avoid. Don't, just because you get a capital call on any investment, don't just blindly fund your capital calls. This is an opportunity for you to do your due diligence again on the project and make an educated decision, okay? Also, don't just say, hey, capital calls are always bad and I'm never going to fund a capital call because, forget it. The operator should have gotten it right the first time. Well, if you ignore a capital call, you probably are risking dilution or some sort of equity forfeiture in the deal. So you need to be aware. Number 3, okay, if a capital call comes from any operator and you are shocked and surprised, it's probably due to this third pitfall, which is, are you keeping up with your financial updates, the regular monthly or quarterly updates that you're getting from the operator? And are you reviewing the financials? Because usually there is a story to be told over time. All right, so let's get into some tactical steps that help you understand which capital calls we're going to fund, which ones are just like, we're going to stay away from, and how to make these decisions. Now, I always want to refer you back to that webinar that we did at the end of last May 2024 with Dan Hanford, because he has been in this game really long time. He has over 70 plus limited partner placements. And I know he's seen it all. Okay. I've also had my fair share of capital calls, and we both will interject some of our advice here. Step one, do you have the money? All right. Can you actually fund the capital call without jeopardizing your financial stability? Now, this is different. Okay. I didn't say, do you have the money to fund the capital call? I said, can you actually fund it without jeopardizing your own financial stability? Okay. Now, the difference is that there's so many different ways to fund capital calls. You can use your own cash, which is the simplest option. You could look at other investments in your portfolio, like stocks, bonds, and mutual funds, maybe other investment notes to fund the capital call. Those are two kind of pretty easy things to do. Um, there's also alternative financing. Now, I'm not exactly a fan of this. I am not advocating for it. However, it is something that should be considered as an option on the table. Do you have cash value in a life insurance policy you could use to fund a capital call? Do you have a home equity and line of credit to fund a capital call? Is there a personal loan that you could take out to fund a capital call? Again, I am not saying use leverage to fund a capital call. But as we go through down this decision tree, especially in step number 2, you might actually think about using one of these resources if you deemed it appropriate. Now, here's also another thing that sometimes investors don't think about. They're like, hey, I could fund a capital call, but the money's tied up in my retirement account. Well, there might be a way for you to fund, the capital call utilizing a different entity than what you originally invested through. Now, make sure that you are working with your operator, working with your entity custodians to make sure to play by certain rules to make sure that's all above board. And then our fifth option is you could potentially bring in another investment partner to fund your part of the capital call. So, for example, if I experienced a capital call and if I didn't have the cash right now, maybe I brought in my uncle who could fund the capital call for me, and then I pay him back over time. But he helps me protect my capital. He's getting a return, right? We can all, work with the operator potentially to make that a solution. Okay. But step number 1, do you have the money? Okay. If you simply have zero means of funding a capital call, getting the money at all, then we really are done. Okay. If there's no real option here to fund it, then don't stress. Let the operator know, hey, there's absolutely zero way, none of these 5 steps work. I can't fund the capital call. Okay. Then that's your decision point. Move on. Okay. But if you can say, okay, well, I have one of these 5 options available to me. Now, what do I do? How do I move through this decision tree? Well, step number 2 is understand the consequences of actually if you didn't fund the capital call. So make sure that you are getting this answer from your operator. It can be in the documentation they give you. It can be in a webinar or a combination of both. Or if they're not giving you clear information, make sure to ask these questions here on the screen. Equity impact. If you don't fund, will your stake be diluted? If you don't fund the capital call, will you lose any sort of voting rights in the deal? If you don't fund the capital call, are you forfeiting or letting go of future returns or profits on the deal should the deal continue to move forward? If you don't fund the capital call, does it jeopardize the actual project's success? All right. So the first 3 are kind of counter to you. And if you don't fund the capital call, is there enough other people that could fund the capital call to keep the deal moving forward? Or are you kind of the pivotal point and the whole deal collapses? Now, this is a decision point. Okay. If the consequences of not funding outweigh the financial strain, funding is probably the best choice. Okay. This step is all about preserving your equity, your voting rights, your future returns, and maintaining asset viability. All right. Now, I want to make sure that we all understand when nobody likes getting a capital call. Trust me, operators hate doing capital calls. It is not what they want to be doing. But as a limited partner, as a passive investor, I just wanted to pass on to you some emotional kind of decision-making tips. One, when you get a notification or hear about it, just take a breath. Okay, you don't have to immediately respond to anything, especially if you're triggered. Number two, make sure you're gathering all the relevant information, attend the webinars, ask questions, fully educate yourself. Education, knowledge is power, right? Use a logistical framework to evaluate options. That's what we're giving you here. Now, number four, this is super important. Don't stew. Set a deadline by which you're going to gather all your information and commit to making a decision, and then commit and move forward confidently once you've made your decision. Now, number three, we talked about, do you have the money? Step number two is, do we understand essentially the benefits or the drawbacks of funding a capital call? If you don't fund the capital call, what happens to the deal? And then step three, we've got the money, we decided that we need to fund the capital call. Step three, let's start doing our due diligence again. All right. Number three, reassess the sponsor. Are they communicating consistently and transparently? Are there any signs of negligence or fraud? Are they seeking funds proactively or out of desperation? Okay. No operator wants to do a capital call. It is a last resort. Now, if there are signs of fraud or negligence, in my book, that is a clear no to participating in the capital call. Yeah. So you probably would be throwing good money after bad. Okay. But if your operator is communicating openly, transparently, keeping you in the loop, helping you understand how the source of funds is going to be used to protect the deal, I think we get to move forward in our decision tree. Now, in this webinar that we did last May with Dan Hanford, he said, you made a tough decision the very first time that you wrote the check for the investment. You'd already vetted the operator. If everything still holds true, the second time you reassess the operator, this should be getting to an easier yes to move forward. But we're not there yet. So step number four, reassess the market that the asset is in. All right. Just like at the beginning of the investment, we just want to do a quick double check on the market. Are things still in our investing favor here? Is population still growing? Job growth still happening? The supply demand trends still either neutral or going to shift to be more favorable for us? If the market is imbalanced, is recovery of this market expected in a short time frame, say 12 to 18 months? Are there any other external factors that are happening? Like, is there a big regulation change that's happened in the market, or some sort of policy change that has happened that would impact the future viability of the asset? This brings us to our next decision point. If the market fundamentals are collapsing, funding may not actually save this deal at all. All right. So again, do we have the money? Should we, is the capital call the best, direction for us? How's the operator? How's the market? Step number five, assess the new business plan. All right. It's not the old business plan we're moving forward. It is now we have a new business plan, an asset, this new ejection of capital is going to move the asset forward. What does that look like? Well, first of all, we need to understand, do we believe the operator's judgment and execution to stabilize and enhance the asset? Does the capital call align with preserving and growing returns? Right? If both of those hold true, then we got a clear yes to move forward. All right. Now, I wanted to give you some real world kind of case studies. And these are two stories from my portfolio that have experienced capital calls, one of which I found not to be viable. So it was a mobile home park deal. Now, the operator clearly, and as I started digging in and asking questions, it was very clear that the operator was mismanaging the funds, meaning they had raised about 1.2 million for improvements on the actual property, and after 3 years, zero improvements have happened. And it became quite clear as I dug in further and further and further on the deal, just story after story of why things weren't happening. Where did the money, the 1.2, go? It just sort of poofed. Nothing had happened on the property. And oh, when I go to do a title check on the property, they had actually lost the property to a tax sale. Did I fund that capital call? No. That is what we call clear negligence and fraud. I'm not going to fund that capital call. Now, here's the story of a viable capital call. So several years ago, I was invested in a residential assisted living center. Now, from the get-go, as soon as it was a development deal, as soon as we broke ground and we got into phase 2 of development where walls are going up, a hurricane hits. And then a month later, another hurricane hits. It was a nasty season. And then 6 months later, we got hit by a major thunderstorm that rolled through the area that not only had a lightning strike on the property, but immense flooding. We get all recovered from that by early 2020, and we're ready to tenant the property with actual residents. COVID hits, shuts everything down. As we remember, COVID was nasty for nursing homes and residential assisted living centers. Now, all these delays did lead to a capital call. We needed to infuse more money into the project in order to get it through COVID, get it stabilized to where we could re-tenant the property and move forward. Now, investors who participated in this capital call, there was a clear path forward, okay? We were able to protect all the equity in that deal, and this project's due to exit, albeit a couple years late, but with on track for full returns. Now, here's the kicker: if I went through my decision tree, would I have funded this capital call? Absolutely yes. But I got stymied in step 1. Did I have the money at that time? I did not. Okay. So I did not fund this capital call and I got diluted because I didn't fund. All right. So again, this is a metrics that I'm going through here today that can really help you suss out which ones are capital calls are good to pursue and then which ones we might want to let go. All right. Now, even if we work through all 5 of these steps, we want to make sure in the future that we're just completely prepared. Okay. As a limited partner, I don't think the industry talks enough about how you as a limited partner can be prepared in your own personal situation for the market's ebbs and flows. Well, one, I would encourage you as a limited partner to make sure that you're diversifying across deals in all parts of the capital stack. Make sure that you have debt deals, maybe even promissory notes, preferred equity deals, that you're not just all in the highest risk, highest reward equity part of the capital stack. All right. That way, like when we hit another market, it's not a matter of if we're going to hit another recessionary market, but when we do, you have other sources of capital and cash flow to help smooth the volatility in your portfolio. How to be prepared, step number 2. Just like if you own the asset directly, make sure that you keep some reserves. Now, for me personally, I keep about 6 months worth of reserves of passive investments of about 10% of all passive investments in a liquid note fund. Something that I'm earning a nice return, but if I had to, I could get at it in order to float these deals. Now, it's not like if I owned my own multifamily building, I would probably carry a higher reserve amount or 100% of my capital needed in a reserve account. Here, as a limited partner, I get to take that down a little bit, but I still need to carry some reserves. And those reserves could double for other type of reserve accounts in your own personal situation. Number 3, I know a lot of limited partners just get caught off guard. They're like, hey, I did the heavy lifting. I vetted the operator, the market, and the deal. I invested my money in, oh, by the way, I'm just going to wait until that asset sells and I don't have to do any other work. They don't read the monthly updates or look at the financials or attend any of the update webinars. And so when things like this happen, they get caught way off guard. So as a limited partner, I really encourage you, set some time aside, maybe it's like 2 hours every single month where you're reading all of your updates and financials on all of the investments you're in. Um, Maybe even getting a VA to read them for you and type up a nice little note about what's happening on each property, just so you're not caught off guard. And then number 5, if you do get a notice that, hey, we might be needing some capital on this project, go ahead and proactively plan, assuming that that call will probably go through. Now, here's the thing. A lot of operators, they have learned that they need to notify if they are expecting a capital call, they need to let their limited partners know way early. And so we're seeing a positive trend in the market, hang with me here, that an operator might say, hey, we might need money, but then at the end of the day, they don't need it because they figured out another path to the end, as opposed to saying, hey, we need money in 2 weeks, send it in. Okay. So anyways, just make sure that you're paying attention to the communication, asking questions appropriately. All right. Now let's wrap up. Okay. Again, this whole webinar is about to help you demystify capital calls, no matter when they happen, whether they happen in 2024, 2025, 2030, 2035. This webinar is meant for you to be educated and arm you with a decision-making protocol in any of these markets at any point in time in your investment career. So let's wrap up. What are our steps here? Question number 1, can we fund the capital call? Question number 2, do we understand the consequences if we didn't fund the capital call? Are we fully prepared for those consequences? Number 3, is my sponsor still who I thought they were? Okay, do I still believe in them as an operator? Number 4, is the market still viable, right? Is it stable? Is it headed in the right direction? Number 5, will the added funds stabilize the property and impact the returns? All right, guys, I just want to say thank you so much for joining me today. If you're here live, we're going to go to our Ask Me Anything part of the show. As always, you can always join our Passive Investing Club. When you join here at passiveinvestingwhitney.com, you get a free one-on-one call with me, understand your investing goals. You get access to weekly educational masterclasses and resources, and then, of course, priority access to our open deals. Guys, if you're here live, don't go anywhere. We're about to start the Ask Me Anything part of our show. Woo! All right, that was a lot of information. I wanted to leave this, some time for Q&A, maybe like 10 minutes today. But hopefully, first of all, I want you to go to the chat box. I want you to let me know, was this helpful? Did we go through those questions that you needed to know? A framework. Is this framework helpful? Again, I wanted to provide you with a framework that you could use at any part of the market cycle, whether 2024 or 2034. So you could get to understand whether make a decision, a more educated decision. I think sometimes people tend to either underthink or overthink a situation. I wanted to give you the right amount of questions to ask. Awesome. Yay! As always, if there is a topic that you want to learn more about, this was requested from several people on my webinars. And so I did it for you guys because you guys requested it. If you ever have a topic you want me to cover, please let me know. I want to know what you're thinking. I want to answer your questions. Oh, somebody said, oh my gosh. One of your best presentations full of information that I hope I never need. Thank you. I should have put that at the beginning. I hope you never need this information, but if you do, you have it. All right. If there's other questions, certainly let's jump on over to the Q&A. And guys, I don't cover any of this in my book, Money for Tomorrow, but I know several people have written me in saying where they can pick it up. You can get it on Bigger Pockets. You can get it on Amazon.com. Let me get out of here and check the Q&A. Oh, yay, we got Q&As. From the perspective of a GP, what are some tips when introducing capital calls to our investors? Ooh, okay. I love this because we actually just did a webinar a couple weeks ago on helping people understand the process of a capital call. And I think this is where GPs tend to miss the boat a little bit, and I see the tide turning here. Okay, number one, if you think you're going to do a capital call, tell your limited partners as early as you possibly can. At least 90 days, right? You usually know a quarter in advance, like, oh, we're like 75, 80% of the way there that we might do a capital call. If you're like, especially 75, 80% of the way there, you're pretty certain that it's going to happen. Let your limited partners know, hey, this might be coming down the pipeline. And if it is, here's the percentage range. Okay. Communicate as early as you possibly can. The reason is because you as an operator know that you don't need to do the capital call until like 2 or 3 weeks before you actually need the money. That is, I just got a notice from an operator today on a capital call. It is December 10th. They need the money by December 20th. Okay. Well, for starters, that's 10 days. And number two, it was right in the middle of the holiday season. That just sucks. Okay. So communicate early, communicate often. You're going to build trust. You're going to build transparency. And now you have more time as a general partner to walk your investors through the questions that they're going to have, because everybody's going to have questions. Not all your limited partners will not have watched this webinar. Okay. So that's number one. Okay. Number two, continue to communicate with your limited partners over and over and over again. Because your limited partners are going to be like, when are we going to know? When are we going to know? When are we going to know? Okay. So like every 2, 3, max 4 weeks, let them know, hey, we don't have any decisions. This is the next step we've gotten with our lender. Keep them. They're a partner in the deal. Treat them as such. Okay, because the lender on their side of things, they're looking at the trailing 12 financials. They're going to get an appraisal on the property or a broker opinion of value on the property. And they're weighing all of that information. There's negotiation going back and forth with the general partner, on what they can't bring to the deal. There's a lot of conversation that goes on behind the scenes. And then you land on a plan. Okay. Your limited partner should have known all of that for at least 45 days, 60 days before you actually land on the plan with the lender. Okay. So just be honest, be upfront, be transparent, keep the channels of communication going. And as a general partner, people respond in different ways. You just understand that. Some limited partners are going to be like your greatest evangelists. There's going to be 20%. They're like, I get it. I get you. We're good. Let me know how much the check's going to be. Then there are going to be, 10% of the limited partners that are like, holy smokes, that is the worst thing on the face of the earth. How could you ever possibly do this? And, they're going to be triggered and react emotionally. Okay. That's why I trying to help educate the limited partner. That's we don't want to react like that. If we can, take a breath, take some space, sit with the message for a couple of days, calm down. Okay. You still might not change how you feel, but at least you're not going to be triggered when you write a response. And then you're going to have that 60% in the middle, 60 to 70% of your investors in the middle that you're going to have to walk through what's happening and how the funds are going to be used. And that is the key point. What is going to get people across the finish line is that they have a clear vision of what you're doing, how you're using the money, and how that's going to translate into a net result at the end. Okay, so Micah, hopefully that helps you there. If you got any follow-up questions, let me know. But that's just my experience as an operator, but also being on the flip side as a limited partner, what I've appreciated. With regards to passive investing real estate debt fund, are investments in that fund subject to capital calls? Technically, yeah. I mean, if you look at your PPM, on any passive investment. I don't care what it is. It can be on, even technically even on your stocks, bonds, and mutual funds, there could be a call for capital. It's just it's probably in the legal documentation, legalese, so far down in the paper. Now on debt funds, this is different, right? We've got a different structure here. There's liquidity. And we're deploying funds. We can't deploy in our fund. Very clear difference. In our real estate funds, if we don't have the cash, we can't deploy it. Okay. Now, in other funds, real estate debt funds that are using lines of credit, they might be using their line of credit from the bank, okay, to fill shortfall gaps. They're deploying that line of credit. And then if all of a sudden they're not bringing in new investor money to pay off that credit, yeah, there could definitely be a path to a capital call there. Okay. So I'm not particularly worried, 10% line of credit just to help smooth, people who are withdrawing their equity, because they do out of a debt fund, return of capital's there. But you have some of these debt funds, well-known, well-respected debt funds that if you look at the structure, they're like 40% levered. And they're lending to themselves on their own projects. It makes my palms sweat. I'm just gonna say that. It makes my palms sweat. So technically, is that in the PPM? Yeah, it's gonna be in everybody's PPM. But it goes back to your due diligence on the structure on whether it's a reality or not on the debt side of things. Happy to answer more questions there. All right. When you talked about your reserves, you said 10% for 6 months. 10% of what? Okay, so and this is my number, guys. I value sleeping very well at night. I will do anything to get a good night's sleep. Okay. And I have been that investor that has had let me tell you guys a little bit of a funny story. And this is why I changed my tune. I had 25, almost 30 single family rental properties, and 5 of them were in Indianapolis. And one Christmas, I had all 5 of my Indianapolis properties go vacant for various reasons. A couple were tenant issues, 3 were like repair issues. I had to switch property management companies. It was a disaster. And I hyperventilated one night. I had 2 nights of just horribly bad sleep. I couldn't figure out what was going on. And if I'm not sleeping well, life's not good. The 3rd night, I woke up in the middle of the night and I was just like, oh my gosh, we're going to be bankrupt. This is going to sink us. What the heck's going on? All my equity was tied up into things. And I went to the kitchen at 2:30, 3 o'clock in the morning, and I started writing out principal, interest, taxes, insurance, just what's the reality of this property staying vacant for 2 or 3 months. Okay, I think this is what I need to cover. All of a sudden I got down to a dollar amount and I was like, I just need $36,000 to float all of this. I was like, I've got that in the bank. And I went back to sleep. So taking that same train of thought, I'm sitting here looking at my investments, especially the equity investments that were invested between 2021 and 2022. Okay, this is me. This is my decision-making tree. Those are all the ones that have adjustable rate mortgages on them. I'm looking at them and looking at my total capital that I have put down on those properties, and I'm carrying 10% of that capital for 6 months, and I have it invested in a short-term real estate debt fund. You guys figure out which one that it is in. And it's making money, but it's liquid enough that if I do have a capital call, I can pull that out. I can fund the capital call, and I've protected my original investment in the deal. Okay, so for 10%, this is me of the original capital I placed. Now, somebody might look at their portfolio and say, I don't have any adjustable rate mortgages in my portfolio. Everything's fixed rate debt. Maybe you just carry 5% or 2%. Okay, maybe you can go lower. Maybe you're taking some really high risk on ground up development that isn't going to pay for a really long time. You might want to take it up to 15%. because those timelines might get extended and you might need to contribute more money to the deal. So it's all relative to the assets in your portfolio. But for me, I'm looking at that very narrow window of what deals that I invested in 2021 into, I guess maybe a little bit in 2020, but all the ones that are adjustable rate deals. Does your reserve rule apply to all investments or just those with ARMs? I would say, I mean, in theory, I would apply that to all equity deals. But for me, I'm specifically, my first goal, okay, consider, if you're trying to figure out, wow, I've got 2 million invested across all my deals. Taking that much money off the table is like insanity to me. Do it in like small chunks. Okay, what is your highest risk portion of your portfolio? Set a little aside for that. So for me, the highest risk portion of my portfolio is any deal that I did at end of 2020 to beginning of 2022 that was adjustable rate mortgage. And I was like, what is the realistic capital call that I could get from that deal? 10%. Let me put it in the fund. Okay. I had that pot of money set aside, but I've only tapped into it like once. Okay. It doesn't mean I'm going to use it, but it's there. Okay. I have it invested in a safe investment that I can liquidate, and it's there for me. Great questions, guys. What other questions do you guys have? It doesn't have to be related to capital calls at all. We can talk about something else. I'll hang out here for another couple of minutes. I also want to give you guys permission to, maybe you can't set aside 10% of your deals into a fund. Can you just set aside 15K or 20K in an account, right? Just like a small amount to help cushion you so you're not so nervous about things. Okay. Do you have a view on the macro environment in the next 12 months with regards to the commercial real estate assets? So I've done a few webinars to kind of get at these questions. I think especially the one, if you look up on our Passive Investing Made Simple, go to on YouTube, passiveinvesting.com. I did a webinar on multifamily investing in 2025. And so there's several headwinds there, that put multifamily and, quite frankly, a lot of commercial real estate, into a positive light. There's a huge wealth transfer that's happening right now. And I think that wealth transfer is only going to accelerate, for better or worse, under Trump. Okay, I'm not trying to get political. This is not political. It's actually apolitical. Okay, we've already seen the playbook. This is what this administration does. They are going to accelerate wealth from one pocket, one part of an investor, to another pocket. Okay, so those headwinds are in place. And so if you're an investor that has money and can take advantage of these headwinds, you're going to be able to build your wealth a little bit easier, probably in the next 2 or 3 years, at least, especially next 2, maybe 4. We don't know. But I would say at least for the next 2, or at least there will be laws that go into play that allow us for the next 2 to 4 years to build our wealth quicker. So I think we need to be prepared to take advantage of that. At the same time, if you have kids, this is a great time to set them up with that education and knowledge. Okay, so that they are in that camp that can take advantage of these type of things. But there's a huge wealth transfer that's happening right now. Millennials are in a spot that they can't actually afford a house and they're okay with renting. That's how they've been trained. They've been trained to rent, and that trend is going to continue. So that's a headwind as well. We're undersupplied in housing. What headway we did have moving forward in order to solve that issue, I think is going to pause and stall over the next 2 to 3 years. So I think that gap is only going to get worse, not better. I really hope I'm wrong on that one. Because I want to see housing to become a little bit more affordable. I want people to have more access to the roof over their head. But yeah, we've got, a lot of baby boomers are retiring from their businesses. They're selling their businesses. They're selling their real estate. Their kids don't want it. That's a great opportunity for you to snag, for operators to snag deals, but also limited partners to participate in deals alongside operators. So we've got a huge wealth transfer that's happening. I think multifamily is going to, if I had my crystal ball, I think multifamily is going to benefit from it first. Self-storage, maybe behind that. There's other pressures on industrial that are secondary to what we just, covered. Office and retail are kind of remain an enigma to me because we just have so many changes that are happening with how, where people work, how people work, how people shop. I think that's going to be really interesting, as it plays out over time. I try to stay away from the court of popular opinion, but I'll give you my insights there. What other questions do you guys have? If not, for those of you who have stayed with us this long, thank you so much for taking the time, not only to spend it here with me, but to invest in yourself. What am I reading these days? Oh, okay. Yeah. I am actually reading about buying businesses and, but more specifically like real estate type businesses. But the best book that I'm reading so far is The AI-Driven Leader. And so that's really changed how I look at AI and how people can utilize AI in their businesses. That I think can really, create an immense amount of value for people. So that's one of the books. It's by Jeff Woods. Jeff Woods used to run The One Thing with Gary Keller and Jay Papasan. But anyways, he stepped away from The One Thing and started his company, and that's his book. It's brilliant. Who is the real estate debt fund suited for? Retirees? The real estate debt fund is really suited, our real estate debt fund, I'm going to be very specific, is suited for, anybody. And it's kind of one of those catch-all investments, right? It gives you diversification across the capital stack. We're lowest risk part of the capital stack. It is designed to be liquid for those people who need it very liquid, and also provide equity-like growth for those people who have time on their side. So you can invest, say, like $100,000 and get an 8% preferred return and just take a monthly paycheck. Great for retirees, right? You could put that $100,000, invest through a retirement account and allow it to compound, say for 10 years. And now you get a 17%, return, annualized rate of return. So you get equity like growth over 10 years. And tax-free because you put in or tax deferred because you put it in a retirement account. If you put it in a Roth account, now it's tax-free. So little hint there on like how I like using it. But it's great, like, to park, I think I call it tier 2 and tier 3 emergency reserves as well. So if you have those reserves that you're like, ooh, I do need access to them, but just not right now, but they need to stay like cash. Anything that I need to get at in under 30 days stays in the bank. That's where I keep it. I keep it in a money market or a CD or something like that. Anything that I can stick a pin in for like 30 days, then I will put it in like a real estate debt fund and tier some notes into that. Um, so I use it like that, to keep emergency reserves earning. Um, it's also a base, I consider it a base part of my investment portfolio to kind of provide cash flow and create stability. And then in my retirement accounts, I use it, it's a great tool to allow it to compound and just continue to earn over time and continue going, because I don't need the cash flow right then. But then if you're, as a retiree, you know, that's amazing too for monthly cash flow. So if you want to learn more, just reach out to me at Whitney@passiveinvesting.com. Happy to talk to you about it, and we can figure out if it's, how is it the right way to use for you. Am I confident that Congress will never tax a Roth given some of the crazy policies promoted over the last few years? I don't pretend to know what Congress will or won't do. I look at what are the odds? So most people in Congress have real estate and they have Roth retirement accounts. I don't see them do anything that is going to be negative that's going to get, that won't be self-serving to them. I'll just leave it like that. So I don't see depreciation going away. I don't see 1031s going away. I don't see Roth accounts going away. Now, that said, if laws do change, you're going to want to have had a Roth account first, because if laws do change, generally and they have on Roth accounts, thanks to PayPal mafia and how they were able to kind of hoodwink the system. Roth terms changed, but people were grandfathered in. So I would get my Roth account open now. My daughter has a Roth account. She has earned income through sources in our business. She has a Roth account, and if things change, oh well, she's 12 and she is grandfathered into today's laws. So I consider that as a generational wealth move, to get one open for your kids as soon as possible. And the other thing that I think about Roth accounts is the money, I've already paid the taxes, so it can grow tax-free, come out tax-free. It also, maybe you don't even like Roth. You're just like, I don't want it for me. It is an amazing wealth generation tool. Like, you can add to the Roth account, and then when you die, all the assets in the Roth account, their basis steps up, and it goes over the next generation tax-free. So it can be a good tax-free transfer of wealth. Now, partner with your CPA on that, because not everybody can contribute to a Roth. There's different rules at play for different, people. So, but it is something to take a look at as far as a generational wealth building strategy. Somebody said, I heard most of Congress uses max cash value life insurance policy. I think they have several things. So, I actually have a group at Ash Wealth, where I help people kind of put these plans in place. Now, I'll just give you the quick list. It doesn't mean that, don't take this and run with it as your plan. This is what I consult with people on. But for me, I would always max out your health savings account first. Okay. It acts like a Roth account or a retirement account, but a Roth account for health bills. But if you don't use it for health bills, it's just like another retirement account. Max that out every single year. Max out whatever you're going to use of your flexible spending account. Okay. Whether it's for dependent care, or dependent care, or if it's for medical, only put in what you need. Take advantage of that. If you're working for a W-2 employer and you get an employee match, make sure you get your employee match. Is it earth-shattering? Like, if you don't do that? No, it's not. For some people, it does make sense to skip. But it is technically free money. So I would take advantage of that. And then I would make sure the Roth account is fully filled. Okay. And this is where it gets fun, because my high income earners, or people that have businesses, we can set up solo 401k accounts, and it just gets super fun to what we can do with those qualified retirement plans. But if you're a W-2 earner, go ahead and set up a Roth account, and yeah, it's $7,000 or $8,000 a year, but you'll be impressed when you start doing the math, and it can compound tax-free. Okay, now I know somebody's going, Whitney, the question was about cash value life insurance policy. Where are you going? Okay, once you get through what I just said to having the Roth account filled, now the game gets really interesting. What makes sense for you and your goals? And this is where it kind of becomes a choose your own adventure based on what you want to do. Does it make sense to actually build out real estate? Take all your cash, put it in real estate. Does it make sense for you, like, to actually contribute to a 401k retirement plan and the traditional side of things, and build out stocks, bonds, and mutual funds? Or do you want to build your own bank and put it in a cash value life insurance policy? Now, guys, cash value life insurance is not an investment. I know it is an enhancer to other investments you're already making. Okay, it in and of itself is not an investment. Okay, so if you are investing in cash value life insurance policy and going, woo, I got an investment there, unless you're taking the money out to go do other deals, you built your bank. That's all you did. It is not an investment. Okay, but it can be an amplifier to add another 1 or 2% return to other investments. And that's where it gets really stinking fun. But one of the biggest things, I know you got to run, and I know and I'll just leave it with you. One of the biggest things with cash value life insurance policy is it takes money out of the bank and takes it away from creditors and predators. Okay. And so when you think about that, people in Congress, if what this person says is true, most of Congress uses cash value life insurance policy. My guess is they're trying to get money out of the banking system and away from creditors and predators, and have it entirely protected so it's there for their own personal wealth. So not a bad move. Makes total sense. All right, guys, we're at the top of the hour. Thank you for asking such amazing questions. I love kind of going off the rails sometimes, and helping people, give them the red pills and think of things differently. Will you do me a favor? Go to the chat, since we talked about so many things today. Tell me, what is the one thing you're going to take away from today and implement into your own personal plan? Let me know that, because that will help me double down on some of the content in those areas and really provide value to you. All right. Well, guys, as always, getting more serious about financial planning. Yep. Awesome, guys. Well, thank you so much for taking the time out of your busy day. We will see you next week. Take care.